The session recordings for HoldCoConf 2022 are brought to you by Axial. Axial is a lower middle market deal sourcing platform. To learn more and to start accessing new deal flow today, head to axial.net.
As I mentioned in the opening remarks, if John's conversation with Emily was the solving his personal problems and letting people eavesdrop, I think that's this conversation for me. I've long thought about maybe our future for our organization looking more like an independent sponsor, so I'm kind of scratching my own itch here, some conversations you and I have had in the past, and I think it'll be applicable for folks in the audience to maybe see a potential path for how to think about structuring their future growth, and I'm excited for this. So maybe to kick things off, if you could share a little bit about your background, your professional experience, kind of set the stage for your knowledge of the independent sponsor market.
Yeah, sure. So first of all, thank you for having me. Excited to be here. I think yesterday set a high bar in terms of the quality of the content, so I hope we can live up to it here. So my name is Aaron Handler out of Dallas, Texas. My story is pretty typical, I guess. I was a kid that thought he was going to go to med school, worked in a hospital, realized in a rare moment of clarity that I didn't have what it took or it would take to be a doctor. And so went to business school instead, discovered finance, became an investment banker, and then got very lucky early in my career and found my way to a lower middle market private equity group based out of Dallas, where we did 15 transactions out of a committed pool of capital, and we're having a great time. It was sort of the, I thought it, really, well, it was very lucky to be there, but it was very unlucky that my boss didn't want to keep doing it. So I either had to find some money or find a job. And I got lucky again, and a family office that was a limited partner within that fund, and had seen, kind of where the junior guys had contributed, was willing to essentially give us a start, and that's how we got Elm Creek Partners started, with the backing of a family office, and we were sort of an independent sponsor before it was cool, and before it was a defined category. We were always raising money on a deal-by-deal basis, and then as the market became more formalized, we just sort of adopted the title.
So let's lean into that a little bit. Independent sponsor, maybe the lowercase use of the word would be, hey, I raise money deal by deal. We have people that give us money, we borrow it, it's equity, and we do deals on a sponsored basis. Independent sponsor proper, could you maybe set the context for those that may not be as versed in kind of some of the norms, maybe your view on how that market's developed, put some color on like the specifics of that term proper.
That's a great question. So yeah, I mean, generally speaking, it's a nuanced term, I think. As an independent sponsor, I'm participating in the lower middle market, so I'm targeting deals 10 to 50 million in revenue, 2 to 8 million of EBITDA. So whether that's lower or micro, we can debate that. The defining characteristic is that I don't have a committed pool of capital that I can, call from. And so I am forming the capital on a deal-by-deal basis. I think the evolution of it, though, has been interesting. It really, in the wake of the great financial crisis, the recession of 2008 and 2010, you had, particularly at the family office level, and increasingly, I argue, at the institutional level, you had limited partners that wanted more discretion over what deals they were being invested in. They were starting to resist being within blind pools, and that really created an initial opening for the independent sponsor model to become more formalized, particularly as on the, what I'll call on the institutional side, the people's willingness to make co-investments or directed investments, became more prominent, on that side, and and it's really been sort of an interesting, I guess, evolution. I kind of believe that kind of whatever you see at the top of the market eventually sort of filters its way down to the lower part of the market. And I think two things, have been driving the independent sponsor world. Again, one is that willingness or that desire, I guess, on the part of investors, limited partners, to have discretion. And you first saw it with the family offices, and then came the fund to funds, then came the SBICs, then came what I'll call just alternative capital providers, and now even committed private equity groups are willing to partner with independent sponsors. And that's, I think the other thing, there's a couple things also driving that, which is, again, not just the discretion, but then also coverage. We've all heard about the private equity overhang that's out there. There's a tremendous amount of capital that needs to be deployed, and independent sponsors are a way for all of these different LP classes to gain more exposure to the market, to cover the market better, and we're force multipliers, for those committed pools of capital, and also, and we can debate this, but I think a lot of the alternative space is being divided. Everybody in this room I probably characterize as an investor. We're really chasing multiples of capital one way or another. Whereas I think a lot of the alternative space are becoming asset managers. And the thing that drives them is, and it affects me, but it's velocity of capital, and the ability to increasingly raise more and more capital and have more and more capital, more and more assets under management. And so independent sponsors play a role in helping them meet their goals in that regard.
Just for the context, what year was Elm Creek founded?
Technically 2006. Kind of got going in 2008.
So you've seen kind of the full cycle of the rise of this evolution in the system. If we look today at the independent sponsor market proper, could you just, no two deals are like, but could you paint with broad brushstrokes what a typical transaction could look like from a capital stack and maybe some stereotypes of what happens in the market?
Yeah. I think a typical independent sponsor deal is probably going to be roughly 50 to 60% leverage, so debt, so 40% to 50% equity. Those are rough percentages. You're going to find that, of that equity, you're probably going to get a rollover part somewhere in the 10 to 20% of that is going to be, from your seller. You might have an earnout on top of that as well, and the balance is going to come largely from, from your equity partners. So I mean, it's a pretty. There's nothing particularly original about that. It's a standard sort of private equity structure.
For sure. And then just touch for a moment on economics for the sponsor.
Yeah. So if anybody's interested in economics, there's McGuire Woods, which is a law firm, puts out a survey every year, and it's become increasingly detailed around the economics of the independent sponsor world. But in general, there's three major components. You're gonna try to get a closing fee, a management fee, and a carry. And then there's terms around all of that. Your closing fee is probably going to run somewhere in the 1% to 2% range of the total enterprise value, of which your capital partner is going to want you to roll some or all of that, back into the deal. And that's in addition to you writing some sort of a check into it that's meaningful to your balance sheet, whatever that may be. The management fee is probably going to range somewhere in the sort of 5 to 10% of EBITDA, with hopefully a floor and probably a cap. They want you fed but not fat. And then a carry, which is likely going to have hurdles on it, either some sort of tiering, some sort of preference to your capital partners before you get to participate in the equity.
For an operator that hears this and says, this sounds like a great business model, we should do this. It's a competitive market. You and I could both go look at a transaction and go to the same capital providers and both try to get it secured. What are the things that we should be thinking about to market ourselves to capital providers? Why do sponsors deserve to get paid? Why wouldn't the capital provider just go direct to the market? Why does this business model need to exist?
Right. Well, some don't think you need to exist or get paid. So you want to try to avoid partnering with those guys. I've met some of them. So, but I think first, what we know is that nobody can cover the entire market, right? So that's number one, right? So even the best private equity groups, if they define their box, here's what I want to see, we know they're seeing less than half, probably closer to maybe best in class is 20% of the market, for whatever it is that they say they want to see. So again, independent sponsors are, force multipliers to whatever their strategy is. So hopefully we're able to bring, differentiated deal flow, and hopefully what we're bringing to them is by the time we have it, it's, either an undercompeted or privately sourced. Even if there's an intermediary tied to it, there's hundreds, if not thousands, of undercompeted deal processes out there, and which we're all hunting for, if not directly sourced.
I'd like to find some of those.
I know.
That sounds nice.
I like the phrase undercompeted because I think everything, it's hard to find something that's entirely proprietary, but you're looking for something that's undercompeted. In a market where obviously multiples have been persistently rising, over a long period of time, there's still the opportunity to find, some sort of value arbitrage or multiple arbitrage. So that's hopefully what you're bringing. And then, finally, you have some sort of an edge, whether it's due to your experience, the management team that you're able to bring, something that gives you an edge or, value added, some sort of value add both on the front end and on the back end, pre and post, of that transaction. We did a transaction where we didn't really believe we had a lot of sort of post-transaction value, and we basically took an outsized closing fee, for it. It was appropriate. Whereas that's not my preferred model. I also like to eat, so there's that. So we, whatever the deal calls for.
So we've been focusing for a minute on the capital provider side of things. Let's go back to the undercompeted deal flow. We write a letter of intent and call up our seller and, hey, great news, we're gonna make you this great offer. I promise we'll get the money, it's fine, somebody will write us a check for this. Talk about how you think about closing with uncommitted capital, how you think about presenting yourself. Elm Creek now has a track record. Maybe how did you think about it in the early days when you didn't have the track record that you have today?
Yeah, well, even today, I got booted out of a process last week where I was bringing a co-investor that could increase the business by 10%, probably out of the gate, an operating partner who had built two similar businesses and could run circles around the current owner. And we still got booted out of a process for two reasons. One, we had an earnout, which I can solve for, but two, because we were an independent sponsor, and I was sort of blown away. So track record, it's still long history of closing deals. It still happens, and it's annoying.
Do you find the bankers and brokers to be helpful in explaining this, or is their view still going to be cash in hand is preferred?
Look, their job, their fiduciary duties to their client, not to me, and they want to maximize value with the highest and balancing against the highest probability of close. And so there is no doubt that look, there's a risk factor, with an independent sponsor, but I would argue, but my argument would be the gap is more narrow than perceived, at least for somebody who's done it a long time. We solve for it by bringing capital support letters at the appropriate time. And we've had a long history and success of being able to do that. And we really view our capital sources as an investment committee. Quite frankly, they make us better. We use them to really in those early conversations from really smart investor sets who are seeing swaths of the market that we don't see, because we're often heads down, looking for our thing. They ask awesome questions, and we've walked away from deals because of conversations that we've had with capital sources, and because they see the deal differently, they see something about it differently, and we've just we take that advice seriously. So we really view them as an asset. We view our capital sources as an asset and try to project that to the sellers. This is how they make us better. Sometimes it works, sometimes it doesn't.
The value prop for a sponsor to go to a seller and say, hey, it's an outsourced investment committee. Instead of me having committed fund, I just, it's outsourced. Makes a lot of sense. Let's talk for a minute about strategy when it comes to having multiple assets and we have multiple sources of capital backing those assets. How do you think about things like shared services, synergies, maybe even conflicts of interest when a sponsor has multiple business activities going on across maybe a microcosm of the world where they specialize and have deep expertise, how should they think about shared services and things of that nature?
So I think, I think in that regard, we're pretty typical, compared to, say, a traditional committed private equity group. We it's not that we don't look for synergies or ways for investments to partner, but each investment tends to be its own silo. That said, you raise a good point, though. Is how do you scale? Private equity is notoriously hard to scale, and I think the answer tends to
it's really easy. It's assets under management. You deploy it. The fees come in. It's great.
I wish, and the answer is systems. And we are constantly looking for systems. I was just having this debate with one of my partners on a deal that we closed a month ago, where just things like I'm advocating for implementing a system like Carta, where you can use for corporate governance and cap table tracking, which today is simple, and my capital partners are kind of looking at me like, why would we want to do this? This seems like overkill. It's like, until you're 5 years out and things change and things happen and people change and things shift. So we think a lot about, no different than the template discussion, I think, that was happening on this couch yesterday. And we think a lot about systems early, implementing things earlier than they need to be done, so that we can, manage more, over time and do it effectively and not run into conflicts. Because we do wind up having, even though we talk to a relatively limited set of capital sources, it's never exactly the same. And we have to, we have fiduciary duties to each of them, that are very similar, and we have to make sure we can find a way to maintain and honor those commitments.
You mentioned a minute ago commitment letters for capital, or that sounds like a great asset to bring to a transaction. Mm-hmm. How do you think, or how would you advise somebody that sees this model, wants to pursue it, with the chicken and the egg problem? I need to get started. I'm not Aaron yet. So I can't yet get a letter from a capital provider. I can go talk to them, but I don't have a deal. I can go talk to deals, but I don't have capital yet. I feel like there's a compounding through time where you frankly have a competitive advantage that you've been in the market. How would somebody entering the market think about that chicken and the egg problem?
Yeah, I mean, capital formation probably is my biggest competitive advantage. And it's just a function of time and having had success doing it. My recommendation is it's all about the reps, right? So, I mean, one of the things that I think folks in this room do better than I do is probably directly source deals. You can take that deal flow and and that is the best opener for a conversation with a capital partner. And you take that deal flow judiciously, and you start having conversations with them, and it's a learning process. You get to know them, you get to know how they think, you understand kind of what their parameters are, and like any other capital partner, and you use that as an iterative process, and over time you will find and you will build confidence. And when the right one then comes along, is you're having a much different conversation, with those capital partners.
You mentioned earlier, I think we all relate to this, the notion of private equity moving down market. You've seen the evolution of the sponsor model. Where do you think we're headed? What are the risks and opportunities? If you had a crystal ball, what happens 5 to 10 years out with the capital providers, the independent sponsor market? What do you see?
I don't know, but I'm infinitely curious, right? What it looks like 10 years from now. Again, kind of continuing with that idea that anything that's kind of going up at the tippy top of the market eventually presses its way down. Somehow there will be more efficiency pushed into the independent sponsor market, in terms of the way the capital formation process happens, which is not efficient right now.
Just make a bunch of phone calls till somebody says yes.
Yeah, kind of. I mean, and look, one of the reasons that we sit where we do in terms of size is because we've migrated towards wanting to have most of our conversations be with institutional folks who are in the market all day, every day, and their parameters are relatively stable. Whereas, when we started, we were operating and targeting smaller businesses, and the capital set there was more variable in terms of, are they in the market, are they not, what are they looking for, and so it's pushed us up market into a more stable market, but it's changed what we had to look for and how we operate a little bit. But even with that, which has made us more efficient, and we have better, I don't want to say better, we have deeper relationships, I think, today. It's still a relatively inefficient process. So somehow the efficiency, both I think in the capital formation process as well as post investment, you see the rise of the secondary market within private equity. LP interests getting traded. Somehow this all filters its way down to the independent sponsor market, and it does kind of call into question. Then is like, well, if it becomes more efficient and more systematized, does the need for the independent sponsor start to decrease? And I don't know the answer to that question. I still think like we're all in a people business, right? Businesses are collections of people, and people are messy, and we all need leadership and guidance at every level, and peer sets and all that kind of stuff. So I don't think the independent sponsor gets eliminated, but I do think it changes over the next 5 to 10 years.
I have one more thing here, then I will open it for Q&A, but again, it's kind of scratching my own itch with thoughts on my mind about the vision that maybe we had down this path one day. And there's probably others in the room that are thinking the same thing. I have a portfolio. I have a bunch of businesses I own. We have some SBA debt, or we have existing investors. We have some machine that exists that is today. And that machine is now bringing me deal flow that maybe I have a competitive advantage, maybe I have a differentiation in. Yeah. And I don't need to change business models. I need to go from true small business up to this middle market, and I can find a larger transaction. How should I, or somebody in my position that's listening to this, think about balancing a current organization in communicating with capital providers about this new business model or new organization? Pros, cons, conflicts of interest, just any thoughts on, I have a business today and now we have a new model going forward?
Yeah, I knew you were going to ask that, and I've been thinking about it, and I've had some conversations here over, kind of trying to quietly survey the room, to try to gain more insight into the HOLDCO framework and mentality. And there's so many ways to answer that, I guess. I mean, the first issue that comes up is sort of the how, why, and what of why you've gone down this path of HOLDCO. Because I think when switching to the independent sponsor mindset, which is basically just a riff on committed private equity, it's different. And to the extent that I'm correct that alternative asset managers are asset managers, and velocity of capital and deployment and assets under management are key, and delivering that premium to whatever the next best alternative is, that requires exits. I mean, and you're incentivized to exit.
So if someone listening to this has had a mindset of long-term hold, I want to be Warren Buffett when I grow up, mm-hmm. and we switch to deal by deal raising capital, it may mean that the assets we buy into that model are not forever hold assets. They are much more private equity, 3 to 5 year mindset to underwrite to.
Yeah. Yes, because your capital sources with some, unless you're able to attract, I mean, never say never, I mean, but the majority of the capital sources that I speak to, if you're talking to fund of funds, SBICs, alternative capital providers, they have incentives to create exits as well. That pressure pushes its way down. It's not good, it's not bad, it just is. And so yes, so these are not forever hold assets. I've always thought of it as I invest in a chapter of the life, of an organization. Sometimes I have to invest in 2 chapters because we messed up the first one. But
nobody else here has done that. It's fine.
Golly, but it's a chapter in the life, and I take great pride in what we've built and created, and then it's time to hand it on to the next one. And and oftentimes the team that we built and what we did, we assembled the right team, and we met the market and did it, and the group that should take it to that next place is a different group. So I think there's an appropriate evolution there, in the life of a company. But and again, when you consider the incentive structure, closing fee, management fee, carry, well, the carry only gets realized if you exit, right? Not only, but largely only gets realized if you exit. So I'm sorry, I lost the thread a little bit, but in terms of like this room, considering the independent sponsor model, I think one of the biggest challenges you have is what commitments did you make to the investors you have today? And to the extent that you're sourcing deal flow because of your HoldCo, are you, and I'm not a lawyer, but I mean, just what is your commitment to they made an investment in your HoldCo with some sense of, that's the asset of the HoldCo. How about that? And are you able to take it and push it over here and do a different deal? So I think that's a challenge that most people in this room are going to face. That said, I think there are a lot of companies being built here which would be great independent sponsor platforms. And you could partner with a guy like me. You could probably do it on your own. You guys are all master capital formation people. We're all salespeople. So but it will require a shift in mindset, and it'll require a shift in who your capital partners are.
Let's open it up for questions.
Yeah, I mean, our ability to, I hate to use the word source an operating partner, but to find operating partners, people with deep industry expertise, is key to our being able to bring the whole thing together. And over time, we've gravitated towards industries and niches and themes where we know we have relationships that we can bring to the table. It's part of what we do on a regular basis. It's not 100%, but it certainly makes the deals better when we can do that. And the ones we get most excited about are ones where we have those relationships that we can call on, to understand nuance, to do all the things that you hope to get out of an operating partner. Sometimes they serve as board members. Sometimes they become CEO. It takes on all different shapes and sizes, when we do a deal.
I don't know what the right metaphor is, but you've gone from chicken and egg to now you have like a third variable in that equation to have the talent to operate that asset.
Mm-hmm. Yeah, I mean, it's as important as the deal itself. Yeah, we outsource all of that. There are people who are going to do that better than me. I want to hire a guardian. I want to, we use a variety of law firms, who bring different perspectives to the deal and have different styles that we try to match to the deal process. If it's a healthcare deal, we might use one firm versus a manufacturer. So we really value our sort of orbit of service providers. They bring a lot to us, and we don't need them all day, every day, right? So better to outsource that.
What is the structure today at Elm Creek? You have a partner. There's an office. Walk us through that real quick. What's that look like?
I'm ruling the world from my laundry room right now. So we're a small team. We're a 2-person team. We've been bigger, as many as 6 people. But right now we're a 2-person team, and it's a straight up partnership between the two of us.
When you were larger, what were those other roles that you had?
Yeah, again, pretty classic. We had a couple of associates and an analyst, at the time. We had a larger portfolio. We've largely, just evolution of Elm Creek, we're kind of on Elm Creek 2.0. My current partner is not the one I started with. I was very lucky to have a great partner for a decade. He moved on to something new, and very lucky to find a new partner. And we've done 3 deals together now. So that's, gosh, if you can find a good partner, that's gold.
I can relate. We got time for one more.
Yeah, I mean, as a small team, right? You get distracted, depending on what's going on either in the portfolio or in the deal process. My sort of rule of thumb is, it's the max per senior partner is somewhere around 3 deals. It's probably more like 2.5. So because the minute 2 of them go off the rails, everything else stops. Right, so it's somewhere in that 2 to 3 range per person that you can oversee, and that assumes that you have really well developed teams at the companies themselves. One of the reasons we focus on the size that we do is that our ability to recruit talent to those platforms is better than when we were operating at a smaller level. It's a competitive market out there. People want resources. And so we can recruit better management teams to larger platforms, which allows us then to do more. So.
I'll wrap up with one last question of my own. So kind of double clicking on that, you have 2 or 3 that you're focused on, your partner has 2 or 3. What's a day in the life? Are you playing board member? Are you parachuting in and fixing problems? Are you getting the phone calls late at night? What has your relationship been? And I'm sure it ebbs and flows through time, but give us like a snapshot.
Yeah. My day in the life is a mixture of deal sourcing, interacting with our senior management teams, in terms of just sort of our weekly cadence, in terms of what's going on, and special projects. And usually, hopefully, those special projects are positive projects. Occasionally, they are not. They are not. Like today, I'll be on board call. I'll be on a, ad hoc board call later this afternoon, solving a negative issue. God, hopefully. And reaching out to our network to help bring resources to bear, on the issue. Yesterday it was, the afternoon was filled with, positive, positive momentum opportunities on a different portfolio company. So it's a mixture of deal flow, problem solving, and then and there's admin work, right? Somebody could solve admin work for me. I'd really appreciate it. If I never file another franchise tax report again, I'd be really happy. But that's the general. Unless something goes terribly wrong, and we have at times had to drop in and be the management team, and we'll do that. That's part of our. We feel that's part of our. Not so much our value add, but our obligation, really, to our capital partners.
That kind of gets back to the reason why the independent sponsor model exists. If you are a capital source, capital allocator, they truly don't want to parachute in and operate as a sponsor. You truly can when you need to.
When it worked correctly, we're the first call, and we're the last man standing. So,
Aaron, thank you so much.